Investors, let's face it, with every passing day, we're all getting older, slowly but surely drawing closer to our days of retirement. Now, some of you out there may very well be there already, or at least much closer than I am, so this one's for you as I review 6 dividend ETFs that will be your financial saviors in retirement. Of course, days spent in retirement are really going to require you to play it safe while simultaneously still bringing in cash flow. That's exactly what all 6 of these ETFs will do for you. And by the end of today's video, hopefully you're going to walk away with a newfound understanding and strategy for retirement on top of a dividend ETF that will be most suitable for you. Ready? So before I cover these ETFs, I just want to start by saying that retirement really may mean different things for different folks. Say if you're retiring early but pursuing a passion project, or on the other hand, if you're perhaps really at that ripe old age to finally just enjoy life and put work aside entirely. Regardless, retiring in all senses of the words means rebalancing your work-life scale, but given you're still going to need cash flow, your investment should continue to provide the cash that's needed to live a fruitful, fun-filled life without financial burdens and stress. Now, many retirees flock to dividend stocks to gain extra money on the side. And trust me, as a dividend investor, there's plenty of money to be made. But there's just one small caveat here that we always need to consider while investing, and that's your investment timeline. You see, the more time you have, the more risk you can afford to take. But without a lot of time on the clock, risk is certainly what you want to avoid entirely. So then, how exactly do we avoid risk and all the pitfalls that come with it? Simple. We target exchange-traded funds, which allow us to invest into dozens, hundreds, or at times thousands of stocks for really the price of one single share. This is true diversification for the sake of risk mitigation. And the ETFs that we're about to discover all have excellent yields, stability, and even capital appreciation. Therefore, you can't really go wrong. With that, let's go ahead and get to our first ETF here with the iShares Select Dividend ETF, ticker symbol DVY, which seeks to track the investment results of an index composed of relatively high dividend-paying equities while granting shareholders with plenty of exposure to broad-cap U.S. companies. And breaking down the fund's portfolio characteristics, we're going to find 99 total holdings. But before I cover the top 10 holdings, I want to go ahead and show you through the sector exposure that you're going to gain from this ETF, with the financial sector stealing most of the fund's weight here, roughly 25.55%. Before the fund covers utilities at 25.31%, consumer staples at 8.84%, materials at 8.65%, and consumer discretionary at 7.3%. So note that tech, which is often the most volatile sector, really doesn't take up much weight, coming in at just 5.39% of the fund's weighting, meaning you're really gunning for stability with this fund. And in other words, now we're talking about Verizon as the fund's largest holding, followed by IBM, Altria Group, Seagate Technology, and OneOak as the top holdings, whereas Prudential, AT&T, Fidelity National Financial, LyondellBase, and International Paper make up the next batch of holdings. Now, in terms of a dividend yield for the dividend income that you're seeking, this ETF certainly delivers, coming in at a 4.04% dividend yield paid on a quarterly basis. But equally as important here, we're going to go ahead and consider that you're going to save maximum amount of money with a lower expense ratio here, to which the fund's coming in at just a 0.38% expense ratio, meaning you're only paying $38 per $10,000 invested. Now, speaking of $10,000, if we invested $10,000 10 years ago, will we now be sitting on $23,229.24? Not too shabby, but we are going to go ahead and get started here with another ETF, the State Street Global Advisors S&P Dividend ETF, ticker symbol SDY, which is going to gift you shareholders out there with plenty of safety by way of targeting high yield dividend aristocrats, which are companies that have a rich history of not only paying dividends out for over 25 plus years, but growing their dividends over time. Now, due to the fund's screening process for companies that have paid 20 years worth of dividends, we can expect that the holdings will experience capital growth on top of dividend growth. So in other words, we're going to talk about companies like 3M, Realty Income, IBM, Target, AbbVie, which come in as the top 5 holdings within the fund, followed by Southern Company, T. Rowe Price, Medtronic, Kenvue, and Kimberly-Clark, which then means, once again, a boot to technology stocks, as we see the fund's sector exposure is coming in with industrials leading the charge at 22.14%, worth of the fund's weighting, followed followed by consumer staples at 21.22%, and then we have financials at 11.52%, materials at 10.23%, healthcare coming in at 7.99%, which now performance-wise will lead to a pretty respectable gain. Should we have invested $10,000 into this fund 10 years ago, we'd now be sitting on a grand more than our last ETF, coming in at $24,658.14, even though the dividend yield is lower, coming in at 2.59%, yet with the same expense ratio at 0.35%. Now, investors, retirees, financial freedom seekers, we have 4 more ETFs to cover, but before we do, join me on the channel by subscribing, as this is going to be your year here to smash your financial goals, and we're going to do that together. And while you're at it, I want you to go ahead and let me know if this content is what you're interested in, what you came here for. That's all you have to do, is tap on that thumbs up button for me. Now, with that, we're going to head over to Vanguard, my brokerage of choice, given their claim to fame here when it comes to leadership in the industry and just notoriously low fees. Now, the Vanguard fund that I want to highlight for you is the Vanguard High Dividend Yield ETF, that's ticker symbol VYM, which seeks to track the FTSE High Dividend Yield Index, ultimately measuring the investment returns of common stocks of companies characterized by their high dividend yields. Now, right off the bat, Vanguard is going to stick to their claim to fame with their expense ratio coming in at 0.06%, meaning you're only ever going to pay $6 per $10,000 invested annually. But what about your overall return? Well, that $10,000 investment made 10 years ago would now allow you to sit at $24,695.16, thanks to the fund's holdings that are going to come in at JP Morgan as the largest, Broadcom, ExxonMobil, Johnson & Johnson, Home Depot, followed by Procter & Gamble, Merck, AbbVie, Chevron, and Pepsi. So all companies I'm sure you're familiar with. You're ultimately going to gain exposure to plenty of sectors, mostly the financial sector, as it makes up 21.5% worth of the fund's weighting, or you're going to tap into industrials at 12.3%, consumer staples neck and neck here at 12.2%, as well as then healthcare and the consumer discretionary sector, all while enjoying a solid dividend yield on behalf of Vanguard, coming in at over 3% at 3.07%. Next up, an ETF that I feel totally flies under the radar, but it's definitely worthy of our praise, the FlexShares Quality Dividend Index Fund, ticker symbol QDF. For all investors who are seeking an investment that really emphasizes quality, as the fund seeks results that correspond, generally speaking, to the price and yield performance before all the fees and expenses of the Northern Trust Quality Dividend Index. Ultimately, we're going to refer here to 134 holdings within QDF, with the top 10 holdings coming down to Apple, Microsoft, so right there, tech exposure, before we find Broadcom, J&J, Procter & Gamble, Coca-Cola, Nvidia, Accenture, Cisco, and AbbVie, with a lot of the fund's weighting in tech, roughly 31.25% worth of the fund, which means that you're actually going to see probably more share price appreciation. But then we have exposure to financials here, coming in at 13.81% of the weighting in the financial sector, another 10.04% in healthcare, before we're going to get into consumer discretionary and industrial sector exposure. All thanks to tech exposure, this fund really delivers through on more growth. If you invested $10,000 10 years ago, you'd now be sitting on roughly $25,579.87, all while collecting, once again, on a lower dividend yield, coming in at 2.09%, which should tell you that dividend yields really shouldn't be your end-all, be-all decision-making factor when it comes to a dividend stock or investment. Now, as for the expense ratio, it's coming in a tad higher here at 0.37%, meaning you're going to pay $37 per $10,000 invested annually. But let's keep on sifting through these ETFs because it only gets better. Up next, we have the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, which is an ETF that's focused exclusively on all of the aristocrats within the S&P 500. So again, the high-quality companies that have grown their dividends for at least 25 years, the vast majority of the fund's holdings having paid dividends for over 40 years. Now, this strategy has demonstrated quite a history of weathering market ups and downs, capturing most of the gains in rising markets, and to the best that it can, avoiding the pitfalls of the losing markets. So take companies like Sherwin-Williams, everyone's go-to paint supplier, or we have Target, S&P Global, W.W. Grainger, IBM, Ecolab, A.O. Smith, Franklin Resources, Pentair, and Abbott Laboratories, all making up the fund's top 10 holdings, but with the vast majority of the fund's weighting in the consumer staples sector, coming in at roughly 24.67% of the fund's weight, with another 23.31% in industrials, and then we have materials before getting into the financial and healthcare sectors. Now, that $10,000 investment made into this particular fund 10 years ago, you would have more than doubled your money, coming in at $26,846.59, all while enjoying the fund's 2.16% dividend yield and only paying $35 because that expense ratio ratios coming in at just 0.35%, which then all leads me to what I would say is the ultimate retirement account, or at least one of the top set it and forget it type of ETFs that are out there. We have the Schwab US Dividend Equity ETF, ticker symbol SCHD, which outshines all the other funds that I mentioned today in terms of performance profitability while maintaining a rock solid dividend yield, all thanks to the fund's goal of tracking as closely as possible for all the fees and expenses the total return of the Dow Jones US Dividend 100 Index, whereas all the stocks that are selected and actually put into this ETF must show fundamental strength that's based on their financial ratios. In other words, shareholders are going to gain 104 holdings for the price of one SCHD share here. The fund's top holdings coming down to Broadcom, AbbVie, Merck, Amgen, Home Depot, Texas Instruments, Cisco, Verizon, and Coca-Cola, but with the vast majority of the fund's exposure in industrials at 17.68% worth of the fund's weight, followed by healthcare at 16.64% worth of the fund's weighting. That's trailed by financials coming in at 15.14% of the weighting before getting into the consumer sector space, as well as tech coming in at 11.71% of the fund's weight, which then allows all investors into SCHD to really kick back and just enjoy the returns throughout all the market ups and downs. After a $10,000 investment into SCHD made 10 years ago, you'd now be sitting on a whopping extra $19,409.32 of a profit while enjoying a higher than average dividend yield for this ETF coming in at 3.53% and paying almost next to nothing for it, as its expense ratio is coming in competitively with Vanguard at just 0.06%, which allows SCHD to maintain its reputation as the dividend investors' go-to ETF. But investors, now I have to ask which ETFs you're holding on to for retirement, or if you're already retired, which ones have been treating you well. Definitely let me know down below in the comments. Discover more dividend stock ideas right here, but before you actually click away, join me on the channel by subscribing, and I'll see you in the next one.